All right, swing traders, let's talk about multiple time frames. We've been doing that already to some extent, but we're going to get a little more detailed about that here. So let's get going. All right, multiple time frames. What are we doing with them? We're expanding data, we're compressing data. So as we look at higher time frames, we're taking data from a lower time frame and we're compressing it. When we take higher time frames and we expand the data, we're going to longer time frames. So when we do that, we see a different arrangement of candlestick patterns or pictures. So when we compress information, we may not actually see momentum slowing down or an actual turn in that lower time frame, which is normal. Understanding this, we don't want to look at too many time frames. That leads to confusion. We want to stick with our macro time frame, our micro time frame, understand what's happening there, and not be looking at so many time frames that now we're getting into analysis paralysis. The tools that we have will guide us. Now, at times, we're going to be entering after a large bar or a bar opposite the direction of a move, but we're going to be trading in the direction of the trend in alignment with support and resistance and the other concepts that we've spoken about. So the odds are in our favor, and here our objective is to understand what's happening in multiple time frames and not be confused by it. Primary time frame, if it's whippy or confusing, you move to a higher time frame. So if we have erratic price action that is confusing, which is telling us stand aside and that there's uncertainty, but for whatever reason we're interested in this particular market or a stock, compress the data, move to a higher time frame, and see if it brings clarity. If it doesn't, stay away. If clarity is there, it'll reinforce a bias, and then you wait for your lower time frame to come into alignment where it tightens up, where the picture of certainties begins to be displayed. And the other alternative is to be, if you're entering from the higher time frame, you're going to be having a larger stop, smaller share size. And so you're in the position and waiting for that certainty to display itself, but with a stop far enough away that you're not going to get stopped out by a wiggle. In other words, you're trading from the higher time frame rather than the smaller, in this case being the daily. Now, if prices are climactic, you're not going to be doing that because of the fact they are climactic. They've gotten extended. So you stand aside, you reevaluate, and you wait for information that supports your bias. So what's our goal here? It's the alignment of pictures in multiple time frames that we're using, which means trend or counter trend. Those trades are aligned in multiple time frames. And it's alignment about your investing and trading goals. So we're talking about swing trading here, not day trading. It's a completely different focus. The foundational concepts, while the same, we're using different time frames to do that, lower intraday time frames. There's no reason for me to look at a 5-minute chart if I'm swing trading. You've probably done that. I've done it in the past. I've given up good positions because of a trend break on a 5-minute chart or a wide range bar on a 5-minute chart. In other words, getting scared out of a position that there's nothing wrong with it on the daily time frame. So keep it in perspective. There's going to be times where a position doesn't work out. The start of a breakdown of a position obviously starts in lower time frames. But you can't be focused on 5-minute charts if you're going to be a swing trader because there's just too much noise there. So we don't. The focus on day trading is looking at what's happening from your higher time frames. Now, the monthly time frame is a long time frame that we can utilize, but until that bar is actually completed, it really doesn't make sense to be looking at it the first week of the month, and you've got 3 weeks to go, and any bar that's there can be completely different by the end of the month. Let's understand transitions. So there are transitions in a higher time frame that are seen, in a smaller time frame. And in the upper left there, we're looking at what would be the higher time frame. And in the smaller examples, we're looking at what would be the transitions from that green bar into the red bar. And that can happen in many different ways. And when we talked about candlesticks, we talked about the fact that these price patterns can happen in so many different ways that we can't say that, hey, it has to happen like this, which is a great pattern, because there was a breakout failure there. It was a big green bar that turned into a topping tail bar. However, we know that this pattern is similar, and because the higher time frame has already given us our bias, that this picture can be used the same as this picture. Sure, this one is a better one, but this one will work out as well as this one will. Just that this one has more of a shock element to it. This one is another variation where there's been a little breakout failure there, a little bit more pronounced, just because it was a closing at its high and then a gap down and it broke below the low, whereas this one didn't break below the low yet. So a bit more bearish there. And this one, we'd say, was the least bearish or benign as far as the turning point happening in that last one. So it can happen different ways. The higher time frame, we've got a bias where the turn should happen, and we're able to observe the actual turn from green to red in the smaller time frame. On this slide, we're taking a bit more detail, going a little further in, and as mentioned at the beginning of the course, these individual modules and concepts are about understanding that particular concept thoroughly. So as we're looking at this, it's for you to understand this transition and looking at things a bit deeper in multiple time frames. That's our focus here. So we've got this big red candle on the left right here. And what we're looking at here is saying, okay, there was this transition to that big green candle. Well, depending on the time frame that you're looking at, it's going to be dependent on how many bars you see. How far down are you going into smaller time frames where this one bar could be where it's just several bars and then the turn occurs, where if we go down to even a smaller time frame, we see that there's the slowing in momentum in the transition from this red bar into this green bar. And if we went down into a smaller time frame, we might see these bottoming tail bars and a retest and a more detailed pattern. Does it mean that we have to go down here? No, because our method requires that prices trade above a prior bar's high for entry. So what's happening between these bars, even if we don't see it, we don't need to, right? Because this is what's going to give us our entry point. Now, ideally, when we look at these individual bars, let's remember bar by bar analysis, whereas if this bar was a bottoming tail bar, I would find that even more attractive, because I know that in a smaller time frame, there's been some kind of dip that's broken some support, and then prices have turned back up again. Let's continue to talk about these wide range bars and multiple time frames, and looking inside where we're taking this X-ray here. So what we're looking at here on this slide, obviously, is we've got this wide range bar here. That's obviously one bar. We've compressed what's happened in the smaller time frames into an individual bar. If we break that down, what we could see, and let's just assume that this is whatever, the monthly bar. And here we're looking at a weekly bar, or this could be a weekly and a daily, and this could be a 60-minute chart. So sometimes, even as swing traders, we may decide to look at a 60-minute chart. That isn't the focus of this class to do that, but you do understand the concept here from what I'm explaining. And the concept here is that in the time frame that we can see where the bars are coming down in a fluid way, and you can see here lower highs, lower lows as it's pushing down. So as I said, we want to assume we have an uptrend in a higher time frame here. And in other words, this, and let's just say, hey, our 20, it's coming down to our 20 and it's above our 50 and they're rising and we're looking for a turn here. Okay, fine. This came down in a fluid way, which is not as bullish as prices that may have retraced, let's just say in a more bullish angle of retracement, something like that. So we've got a steeper angle of retracement. And if we look inside these bars here, it may actually look like a trending move to the downside here in this time frame. So what do we want to see here? Well, with an angle of retracement like this, clearly there has to be a turning point. If it happens in, say, let's just eliminate this. If it was to happen in 2 bars on that time frame, well, this probably starts going sideways like that, but it may not have violated the trend. If we were to get a 3rd bar on this time frame, and what I'm getting at here is trying to find the ideal type of setups where there's been stabilization after a sharper angle of retracement that has been fluid as explained. So if this goes sideways for multiple days, let's just say this is the daily and this is the hourly, pick the time frames, the focus here is the concept, and that on the smaller time frame you're getting retests, and where we're getting this basing type of pattern where you're moving away over time from the bearish retracement. Whereas if we were to get that type of bullish angle of retracement above the 20 MA, it's already, that angle of retracement is several bars as well, and it's forming some support. But this one being more bearish, ideally it's going to take a little bit of time to rebuild or repair the damage. Now, remember individual candles that form, and let's say for the moment the candle that formed here on this pattern was a wide range bar, and in addition to that it was a wide range bottoming tail bar. That scenario would be okay, right? Whereas maybe this has not based out too much. I'm sure it would, but what you would have in a scenario like that would be a downside shakeout pattern, which would build up some support, and it would be a pattern in which there's that shock, where there'd probably be like a climactic type of a move, which those that were possibly long, that were holding through this, they gave up their shares. So a wider range bottoming tail bar where that would display a climactic emotional type of a move would be one in which we'd find that attractive as well, to get long above that bar. And so when we see these kind of downward moves like this, again, we're assuming uptrend. Sure, there'll be stopping points possibly above this, but the bigger picture, right? The big picture, the uptrend, multiple time frames, all of that suggests the ability to get above resistance areas. So that is the same idea behind buying a pullback in price within an uptrend to minor support and a rising 20 MA. That prior high is going to be resistance, but the big picture guides us to the probability that prices are going to overcome that prior high. And here we're taking that same idea or bias and drilling it down into smaller time frames and understanding what's happening there. So here, let's assume that prices are in a downtrend on our macro and our primary time frame, or it's a wide range bar igniting a move down out of a base, and we have the same scenario of a wide range bar, multiple bars, momentum move inside of that bar, and then even a smaller time frame we've got a trending type of a move. So I've drawn this one here where you've got the end here accelerating, or you've got a wide range bar ending here where we can see the complete candle, And what we want to see in the bearish scenario is that prices are going to stay in the lower half and ideally the lower third or so of this wide range bar. While we're looking at one individual bar, and we might be doing that as a swing trader, looking at our daily bar like this, and this could be what happened intraday, this is giving us an objective reference point to say whatever happened here, however that actually formed, as long as it stays in that lower half and closes below that, the assumption is that what's happening in the smaller time frames will be okay. Ideally, it's going to stay in that lower third or lower quarter. Now, as prices do whatever they're going to do in the smaller time frame, we can mark off our major support point, and what we want to see happen is it stay below that ideally, but it could change the trend on that smaller time frame. And I'm repeating, this is about understanding what happens in multiple time frames. But our focus here as swing traders is going to be our daily, our weekly, and to some extent the monthly. So when this retraces here, it could overtake this area, this swing high. But what we're looking for, the ideal scenario would be for it to stay below. And because this is a void here, what we're looking for is a retest pattern or an M-top to sell short. That type of situation, looking for prices to continue to go lower because of our higher time frame bias. Short review, multiple time frames, they guide us to the alignment of trends and inflection points. Now, it can be rare to have all time frames in alignment. The more time frames you look at, the greater the probability that they're not all going to be in alignment. They don't always have to be. Expecting them all to be can lead to indecision. This is the mindset of perfection, the holy grail, a fear of losing any money, looking for that perfection. We don't need it. Our focus as swing traders is to look for our macro and our micro time frame to be in alignment with trends, support, resistance, and the price patterns that say that prices are ready to move in the direction of the prevailing trends. So our job is to pick our time frames based on our bias. Right? We are looking for that primary time frame to be in alignment. The time frame below your primary can be used to refine. And so this leads back to my comment that if we were going to use an hourly time frame to refine an entry point where our weekly and daily time frames were in alignment. If you want it, you could certainly do that if you're in front of your screen, but realize that your higher weekly and daily time frames being in alignment and getting your reversal in your daily time frame where your stop is going to be placed based on that higher time frame. The idea or theory behind that is that it's going to be far enough away to sidestep any wiggles that are going to be happening in the lower time frame, which reinforces what I said earlier too about there's no point in looking at 5-minute time frames if you're a swing trader. Right? The idea behind swing trading is to find our trades based on our time frames and plan, and even being able to place an order at market open or prior to market open and saying if prices trade above this level, buy. And if that happens, put a stop below this level. They can automate that, or you can, do that manually, of course. But the idea here is to be freed from the intraday time frame and sitting in front of a screen for endless hours. Let's continue looking at multiple time frames. And the example on the left is the weekly time frame, and we see this huge wide range bearish bar. You see the star above it. It's a powerful bar. It engulfed multiple weeks. And so that type of bearish bar strongly suggested that prices were going to go lower. And that was followed by an inside bar, or what we call a 1, 2, 3 type of continuation pattern. So this was hanging on a little shelf of support there, but that bearish bar being at support should still follow through to the downside because of the potency and power of that huge bar. Now, as it says, while it's powerful, it's the weakest link because you understand the concept that a wide range bar is a momentum move in a smaller time frame. So if it doesn't follow through, it's a shock, and now there's nothing to stop it from going higher. So looking at the daily time frame, you can see the momentum move here, and then this stabilization down in this area. So the expectation is not for it to go back up again. The point of this slide here is to understand that it is the weakest link and that this is a possibility that it could retrace. And the fact that it did really is a shock in a sense. We would not have been caught in that because we would require this to trade below this low to trigger it as a short sale, which would mean that it went sideways here for a period of time and then it broke lower. So we would not have been caught in this, but we want to recognize the possibility that this could happen because of the fact that this is a momentum move. Now, one of the concepts, I'll just touch on this shortly here just so you understand it, because it's probably raising the question for you as to, well, what about all of this? Well, one of the concepts from Master Trader Technical Strategies is that if prices trade above an area and below it, it neutralizes it. In other words, it's kind of used it up as reference points of support and or resistance. And in reality, the only thing that really matters is this part right here. And this price action actually proves it. I mean, over the years of watching price action and questioning why certain events happen, when it appears that, you know, you've got all of this resistance to the left there, because it's beyond what's directly to the left, meaning this move down, the reality is it's meaningless after prices have traded above it and sliced back through it like that. It's as if it doesn't exist anymore. Yes, you can see it, but you have to recognize what's happened here and that is the weakest link. And if this doesn't follow through to the downside, those that are shorting, let's just back up here, those that would probably be shorting here are going to be getting caught on the wrong side, and that could create a lot of demand to push prices higher. So this isn't our expectation for prices to retrace back up. It's to recognize that it really is the weakest link, and it's supposed to follow through, but if it doesn't, it could have a reaction back in the other direction. So we covered this, just reviewing at this point our weekly time frame and our daily time frame, and how we have a macro view and a micro view, and we're looking for those two views to come together, whether that's pullbacks or it could be a consolidation that creates support. We're looking for alignment of our time frames with an event, bottoming tail bar, one bullish 180 type reversal, bullish wide range bar, 1, 2, 3 type of pattern. Many different ways it could happen. We're looking for patterns to occur that tell us to take a position when we have multiple time frame alignment. Now, counter trend setups. Well, at some point prices will accelerate to the upside or the downside. And how do we handle that? Well, back to trend analysis and turning points and support and resistance. So in this example, what we're looking at is that prices begin to accelerate, and you can see here how these moves up and down are about the same, and then they expand, creating these voids below, and expand, and as they push up into this area of resistance or supply, the probability of that trend ending increases dramatically. Why do prices accelerate? More buyers and more buyers, fewer shares for sale, or demand is overwhelming whatever supply there is. Why does it happen in an area of supply? Because the majority either aren't aware of it, they don't care, it doesn't matter to them that prices have been trending higher for an extended period of time and possibly going vertical. That is all about a reflection of greed when prices are going up and fear when prices are going down, where, rational thinking is no longer part of the analysis, or maybe it never was for some. But as it comes into that supply area, as master traders thinking objectively and intelligently, we're not going to get in front of that. But what we can do is look inside of what's happening here and looking in our micro time frame and looking for that sideways price action. We would combine that with bar by bar analysis, eventually the break of a major support area and a retracement or consolidation with the appropriate candle pattern. That would tell us that we can go short and trade against what's happening in that higher time frame. I say you flip over this concept, right, for longs where it's going down, and we looked at that in one of the wide range bar slides where I explained to you as it went down, or maybe how it came down to multiple bars, and what we're eventually looking for, some bottoming process where things turn back up again. A little more review of our multiple time frames and looking at the daily time frame. Monthly 10 MA, same as the 200. Weekly 20 MA would be the same as a 100. We don't have that on the chart, but we know where the location of that 100 would be by looking at the weekly time frame. And on our daily, we've got a 20, a 50, and a 200. And as we look at these, we say the 20 does not have to be rising for us to take long setups. Because in this picture that we have here, we know that a correction was ongoing because the 200 is declining, but prices started trending up, and eventually we had a power move up and then a pullback, which turned out to be a downside shakeout and a consolidation. So we look at this objectively, intelligently, losing multiple time frames, and of course, look to the left. Is there a void here? And if there is, the start of this move, right? It's the start of a move. Look at the 200, look at the distance between the moving averages. This should go significantly higher. Okay. Daily, weekly, monthly. So we're looking inside of the bars here, and as we look inside of those bars, here we've got this 180 reversal right there. Sloppy bottoming type of price action. As already mentioned, sloppy price action in a lower time frame. If we compress it, we should see things quite a bit clearer. So that green arrow is pointing toward the exact spots. And here we do see tails on the top and we see some tails on the bottom, but we recognize this as a consolidation up at the top of the range. And notice the size of the bars here, here, and how they tightening up here. So certainty is coming into this stock as the ranges and candle bodies begin to tighten, and that bottoming tail bar that formed right there was a bearish wide range bar that went to the bottom of the range, but the body closed in the top of that wide range bullish bar, and that is a great pattern to suggest that prices are going to go higher. The monthly time frame is in an uptrend. Yes, there's a big bearish bar there, but bearish bars are supposed to be ignored in a bullish trend. Remember that from a prior section. At the low of the wide range bar, there was a transition into this bar here. I want to say, for a moment here as we're going through these examples, that I'm giving you a lot of information at this point. Some of you might feel a little overwhelmed with digesting this. It's understandable. I've been doing this a long time and teaching these concepts, so I understand what students go through to absorb this information. The point here is you want to focus on these concepts, meaning here multiple time frames and compressing data and recognizing the foundational information as to what is a picture of certainty, uncertainty, what is the arrangement of those candles, what do they look like, the fact that you can compress data when things look uncertain as they do here in this example of this daily time frame that's in a downtrend here. We've got, you see the 20, how it's got these bumps as I referred to them, rather than a nice fluid kind of straight movement down. So the bottoming process that's beginning here leads you to questioning why. Not that you have to do anything at this point, but as you go through this information and listen to it multiple times, you'll see that it's really a lot of common sense thinking when you boil it down to that and understand it, and then looking at that and then picking your points when you have the alignment of a picture of certainty with multiple time frame alignment. So as we look at the weekly, and I look as I compress this, don't you see how it brings clarity as to what's happening here, that this bottoming process is happening after this trending down, and there was this shakeout, right? The bottoming tail shakeout. Notice the volume that occurs at this point. Do we want to do anything? No, not yet. We're just recognizing what's happening here. So as prices are coming down, what I explained to you on the slides with the wide range bar and multiple time frames is what's happening right here. We see that prices have moved down. They're in a downtrend. And now we recognize that it's in an area here of support where it should turn, and it's become climactic, and we've got this big green bar. Well, as I drill down to this time frame, what I want to see is that sideways movement that's going to take a few weeks and maybe another month, where it goes sideways here and builds this support, and to where this whippy type of price action begins to tighten up. And now it's developed to where prices could move up into what should be a void, which was created over time, and these moving averages are going to start flattening out to where the 20 starts to inch up over the 50. So as this picture evolves and we see what's happening on the higher time frames, it points to us as to why it's happening and provides us with an opportunity to trade long. And so it's not in an uptrend yet. I mentioned bottoming patterns have a tendency to fail or be whippy until they eventually get into that uptrend. And we know the picture of that. What it looks like is when that 20 is rising above the 50 and the 50 is rising, and eventually, this one could take a while before the 200 is eventually under here. But that's another excellent point to recognize, that we can be going long a scenario like this where the 200 is up here, and we recognize that and say, well, when it gets up there, odds are there's going to be sellers up there. So our plan then becomes that because of the price action, as explained, it's not here yet, we can trade a long setup with a target area and recognizing that the 200 is up there above waiting. Another example, daily, trending up, right? Moving averages are trending up. Recent bullish price action of going sideways. Red bars ignored. What should you do here? Well, look to the left. And sometimes when we compress data, right, that's one of the reasons we compress data. I can scroll back on the daily, but if I compress it, I see more information, and I see the weekly is into an area of resistance, and that there's a wide range bar after prices were trending up for a while, rather than an igniting wide range bar like we have down here, on nice volume and a red bar ignored, we've got a wide range bar into an area of resistance. Now, I like this daily chart, so what should I do? Well, I would say let's wait for that to consolidate a while and see if this data or this demand could absorb the supply that's over here, and maybe the 20 MA would eventually catch up, and we bar by bar analysis would give us more red bars ignored or bottoming tail bars to where this could be ready to make new all-time highs. You can see the monthly is a whippy consolidation up at this resistance area here. So the message here is to stand aside. We have a neutral to bullish bias, and we're going to wait to see. But the takeaway here is that this bullish daily time frame is not one in which we should be looking to buy above these highs at this point in time. It's not that far from the 20, but the fact of what it did on the weekly and up at resistance tells us that this isn't a high probability setup to be buying any kind of a breakout, especially one that isn't as developed as we would want to see in this situation like that. Bearish upside shakeout. Well, bottoming action here. Not totally unusual for such a thing to happen. Have an upside move that winds up failing and coming back in again, and then buyers stepped up again, and this sideways price action that is occurring over here, it's still pretty erratic, but we're getting these red bars ignored at these start areas, and then inside the green box we see this bullish price action that begins to occur, and then the wide range bar up. You'll of course take notice of volume spikes that are occurring. That's a little baby spike, but notice it happened on a red bar that didn't follow through. And then we start seeing creating support, sideways consolidations. Notice the big bottoming tail bar right there. That was a big red bar that turns into a bottoming tail bar, and the red bar ignored. So bar by bar analysis here. We have our 20 rising. It's no longer whipping back and forth through the middle of prices, which is a picture of uncertainty. The 50 is rising. The moving averages are now getting above the 200, and prices are now trending up. Bottoming tail bars, red bars ignored. Again, you're looking to the left. We're here looking for pictures that communicate a continuation of this bullish price action. I've already spoken about volume, and these are your foundational volume guidelines. My primary focus is spikes. This is the ideal where volume increases in the direction of the prevailing trend, and ideally it's a volume spike as prices break out on a wide range bar. And as prices pull back, it happens on lower volume, and then volume picks up again if prices pull up into an area of support in an uptrend, or in a downtrend come up to resistance. We want to see that activity pick up, but it's not an absolute necessity for that to happen. Prices can continue and buyers will step up without volume increases, but the ideal is when a move starts, a power type of move, wide range bar or multiple bars moving up out of a consolidation, that you see this volume spike. That's your confirmation, and that's the most powerful thing that you can take away from volume, is to recognize volume spikes where they're igniting moves, potentially ending moves where they become climactic, and then you get a volume spike. But the pullbacks on lower volume, it may or may not happen. I mean, we heard for years and years that the market could not continue to move higher because of the fact that it was moving up on lower volume. Lo and behold, it's been going up for a number of years on lower volume. So that theoretical of that prices cannot go up on low volume is false. The same way of trend lines being an indication of a trend break is false. And about Fibonacci retracements being real support or resistance, it's false. So there are many concepts related to technical analysis that are accepted as fact that are absolutely are not. And looking at it objectively, it frees us from that misinformation. So volume, pay attention to the spikes. That's the takeaway there. And here's examples of that. So when we see these big spikes that are occurring on these examples here, right? Gap down, big volume spike. Pay attention, huge wide range bar. Prices coming down to an area of support, volume spike. Pay attention. Coming down hard, wide range bar, volume spike in an area of support. Here we're seeing this bottoming type of price action that's occurring. Why? Look to the left. Look at your higher time frame. Look at the weekly here that's occurring here in the area of this prior bottoming tail bar, red bar being ignored. Are you absorbing the power of this information here and how putting it all together puts the odds in your favor? Now, as we drill down inside of here, this wide range bar, huge volume spike, buyers are stepping up here through this whole area and accumulating, and we see that on the weekly time frame. And now as it begins to improve, here's the pullback at the big green star. So while there's still that level of uncertainty during this bottoming process, after prices move up, as they did here, and take out this resistance area, that bottoming tail bar is a little continuation, which is happening right here. You're seeing that in multiple time frames, and this whole bottoming process here that took a few months resulted in this moving up, and then you see how the ranges begin to contract, and what we've covered already. Another example, weekly uptrend with rounding bottom and bottoming tail bars, which we have right there. And you can see it here. Now this is pretty whippy type of price action, and you can see how the 20 MA is intersecting through the middle of prices. And at that point in time, we really don't want any part of this. However, as time goes by, things begin to change. They evolve. And we see prices clearing this area. That red bar that turned into another red bar as it broke down on volume. Prices started going sideways again. Bottoming tail bar. Notice there wasn't a big increase in volume on that one, right? So sometimes it happens, sometimes it doesn't. And then we get a nice consolidation here. But that's the money bar right there. So there's the breakout. And then this was a big red bar engulfing all of this area, and it turns into a bottoming tail bar, wide range bottoming tail bar, range expansion bar. You've got climactic kind of move. If we were to look at this in a smaller time frame, it's emotional, and then the bottoming tail bar shows commitment, and then there's this move up here. And looking at this on the weekly time frame, you see that rounding bottom that occurred there, and boom, and it was trending up here. Right? All right, let's look at another example. This is a long section, folks. I know it is, but it's so important, and I felt it necessary to give you a lot of examples and a lot of explanation to understand what's happening in these multiple time frames. So you do know you can pause it at any time, take a little break, and come back to it. That's the beauty of having these courses recorded like that. But let's continue as I explain here what's happening on our weekly. So on our weekly time frame, we've compressed the data. That's the definition of going to higher time frames. And what you see is just a fluid movement of bars going up. Well, that's great, and it tells us that that's bullish and it's going higher, but the weekly time frame doesn't give us any pattern of entry, and it doesn't have to. Our primary focus is the fact that it's going up. We've looked to the left, we've done our multiple time frame analysis, we have our bias, and now as we move down to the daily time frame with that bias, we look at what's happening. Wide range bar moving up. that bottoming price action, and that retracement is bullish. This bottoming tail bar that was a downside spike resulted in the bottoming tail bar, bullish price action at the area of that topping tail bar and that consolidation. It's bullish. The moving average is pointing to the upside here. Prices are going to go higher. Pullback into support. Red bar being ignored, and so on. We just continue the process over and over again. On this side, we're taking a look at the volume spikes. We can see that those volume spikes are occurring on big red bars, but they're being ignored, and we've got rising 20 and rising 50 with the 20 above the 50. So prices are trending higher. And I'll say that, this pattern that we have, it's not all that attractive, quite honestly, because it's all whippy. But we're recognizing these spikes, and it's still trending up. And this is what I refer to this as a self-correcting uptrend, and they're really difficult, if not impossible, for myself anyway, to participate in. And it did begin to tighten up over here. Especially where we see this red bar being ignored. I don't know what's over to the left over here, but we do see that there was a breakout on a wide range bar that winds up failing, and then prices eventually, they trend down or break down under this major support area. And so now we've got a declining 20 MA under the 50, and it's not that we're interested in the moving average crossover here. And moving averages are visual aids that help speed up the analysis. So I can recognize the fact that this is broken down, but as I'm flipping through my scans and looking at pictures, I do recognize that the 20 is under the 50, but the 50 is flattish here. So it's not trending down over a longer period of time, where it's just getting started, because here, where they're trending down together, we know that now the trend is underway, and it should continue to go lower. Now, once this broke through multiple points of major support, well, you're looking for short sales in areas of resistance, and the 50 MA does become, and can become, I should say, a self-fulfilling prophecy. And when it reaches that reference point, we can see that there was a breakout failure that occurred over here, and it turned into topping tail bars, and that is bearish price action that tells us think short. Doesn't tell us it was going to gap down. So I haven't gotten to this yet, but I'll mention it, that you need to be aware of news and earnings reports. So while we've got this attractive pattern to sell short here, it may have been reporting earnings that happened on this day, which would suggest we really shouldn't be short, because it could have gapped up and went higher. So something to keep in mind, that news events could keep us away from what could be a pretty attractive pattern. Now, this retest pattern that's happening down here, that would certainly catch my attention, but not for a swing trade. It's below all the moving averages. The 20 and the 50 are pointing lower. So while it has stabilized in this area, what I'd be more interested in is, does it go sideways over a period of time and form something like this where I could short it? And what should it be checked? Well, by now you're looking to the left to see if there's a price void. Now, this aside, and it's a different subject, but this type of price action where it's retesting that low, while I wouldn't be interested in this as a swing trade, it certainly could set up a put spread. Right? So we could look possibly for a bullish put spread for an income trade, but only with short time to expiration. Meaning, if I could see this pattern and find a spread where we could take in some money and say, hey, do I think this would stay above this level over the course of the next 5 days? That would be a reasonable thought, because I'm still looking for this to go sideways over a period of time before I would even consider it as a short. And like if this was in an area of support on the weekly time frame, maybe it could be a bottom, but that's not our focus here on this slide. But just wanted to mention that these kind of patterns, while the expectation based on what's explained would be lower, they do become put spread candidates in our weekly options trader because it's a very short period of time where we're looking for it to hold. Now, what we're looking here is a weekly time frame. It's making higher highs and higher lows. We're looking for buy setups. As mentioned, the 20 MA is pointing higher, so we know that the 100 MA is pointing higher on the daily time frame. So let's go take a look inside of it. And here is the same chart, the daily time frame, and I've got a 20 above the 50. Both are pointing higher, and I've got this very nice retest pattern that is forming down here. Right? Note the bottoming tail bar that took out the lows, and it moved back up again on the retest. You had that nice volume spike as it pushed up, and look how tight the moving averages are here, which tells us that this is really just getting started. And they were a little further here where there was a move up and it corrected down, and then it consolidated, and then that gap up on increased volume, and then the pullback where it tests the rising 20 MA and the area of that prior low. Great setup as a swing trade, expecting prices to go higher. 20 and 50 rising. We've got a retracement into the rising 20 MA as it's pulling back, and I really like this type of a pattern. I talked about this kind of a pullback here, this angle of retracement, and how this builds up an area of support. As we talked earlier in this section, how multiple days going sideways can create a basing pattern on a smaller time frame where you see downside shakeouts, which are these bottoming tail bars. But on this time frame, I really only need to see the fact that the trend is up. There was a powerful move up on increasing volume. It's pulling back into the rising 20. The 20 is above the 50. These bottoming tail bars telling me that there are downside shakeouts that are happening intraday. And this little sideways price action that is occurring there is building a base for prices to move up above. You might be saying, well, Greg, what about those topping tails up there? Well, trend and powerful moves are respected more than a prior high. And this type of bottoming action, these bottoming tails, are helping to dissipate the potency of this area and the potential supply that'll be there. So when we look at an uptrend, we give the benefit of the doubt to the trend, and pullbacks with this type of price action are supportive that prices should go higher. Now, clearly prices stopped there and they went sideways. What are you looking for? Price action in that area. Bar by bar analysis. Red bar being ignored. Bottoming tail bar. That tells you everything's okay. No doubt the red bar gives you concern on that day, but on the next day, it's dissipated. Right? So the price action is bullish there, and of course that resulted in prices going higher. So there was your entry as it traded above the red line. Stop goes below the green line, and then you go into management mode to see how the trade's going to play out. Another basing pattern, and in this example, prices get a bit extended, but look at where they started from and how the moving averages are close together there. And here's a volume spike. There's a big volume spike as prices move out of the base, and we get two wide range bullish bars that result in a sideways consolidation at the top of the wide range bar, with topping tails being ignored, more bullish price action, and then as it gets somewhat extended from the 20, it just continues to go sideways there, and red bars being ignored. So as we look at this, we have no reason to believe it won't go higher based on what we have here. I'm repeating, but of course you're always looking to the left, but 20 is rising above the 50. I don't know where the 200 is, but I'll tell you, if I saw the 200 right here, which it's not, but if I saw it there, it would give me pause, because that tells me that the 10 MA is declining on the monthly time frame, and I should take a look at that. Short review, right? Our primary time frame, our daily. It's got to be trending up, down, or sideways. And if it's sideways, I'm not too interested, unless it's a bottoming process or a topping process, because my primary focus is trending setups, either up or down. So that time frame above your primary, we want that to be aligned as explained. We explain transitions from red to green and vice versa, right? They have to be relevant in your primary time frame. Is it at an inflection point? Is it at minor support? Is it at major support? So we're always combining trends, support, resistance, and patterns. Right? Wide range bars in that higher time frame is going to be a momentum move in a lower, and that creates a price void. Failures, they start in a lower time frame. At this point, you have an understanding of multiple time frames that will take you to wherever you want to go. Understanding of this and the combination of these concepts, putting it all together, and it says you're becoming a master trader. You have information here that is not based on subjective information. It's price information that's being created by everyone that's trading, and you're able to recognize that objectively with the concepts that you've learned. Let's continue to the next section and continue to put this together.